how BlackRock, Vanguard, and Fidelity are positioning themselves in the Bitcoin space. In 2025, major financial firms like BlackRock, Vanguard, and Fidelity are steadily increasing their involvement in the Bitcoin space. But what does that mean for the average investor, and why now? In this video, we explore the strategies these asset management giants are using, what recent moves they've made regarding Bitcoin ETFs, and how traditional finance is adapting to the evolving world of the digital assets. We'll break down the facts, examine the market context, and look at how long-term positioning is quietly reshaping the financial system behind the scenes, without hype or speculation. Whether you're a seasoned investor or just starting to explore Bitcoin, understanding these institutional movements is key to seeing the bigger picture. These firms collectively manage over 20 trillion in global assets. So when they make a move, it's not just business, it's a signal. We're not here to hype anything, no price predictions, just facts, strategy, and why this moment matters in the larger financial shift that's happening now. Let's get into it. Let's start with a quick recap of who these firms are. BlackRock is the largest asset manager in the world. As of 2025, they oversee more than 10 trillion in assets. Their influence spans governments, corporations, and retirement accounts. Vanguard, known for its index funds, manages around 8 trillion. They've built a reputation on long-term investing and low fees, appealing to retail and institutional investors alike. Fidelity is one of the oldest investment firms in the US, with over 4 trillion under management. They've been quicker than most in embracing digital assets. More on that in a moment. These firms aren't startups. They represent establishment finance, and their entry into Bitcoin marks a major shift in how digital assets are perceived. The timeline of moves. Let's look at what these firms have actually done. BlackRock filed for a spot Bitcoin ETF through iShares. That ETF, now approved, allows clients exposure to Bitcoin without having to manage wallets or cold storage. More importantly, BlackRock's entry gave institutional legitimacy to Bitcoin on Wall Street. Fidelity launched Fidelity Digital Assets back in 2018, one of the earliest moves by a major US firm into crypto infrastructure. By 2023, they were offering Bitcoin trading and custody services to institutional clients and select retail accounts. Vanguard, while more cautious, is connected indirectly. They hold significant shares in companies like MicroStrategy, Coinbase, and Tesla, all of which have Bitcoin exposure. So even without directly offering crypto products, they're exposed through equities. All three have shown clear and calculated steps, not hype, driven moves, but slow and deliberate positioning. Why they're doing this. So what's motivating this shift? 3 main reasons. Client demand. Institutional clients, hedge funds, pension funds, endowments have been asking for crypto exposure. These firms can't ignore that. Offering Bitcoin products meets the demand while retaining assets under their management. Diversification strategy. As inflation, interest rates cycle, and global uncertainty shift the investment landscape, Bitcoin is being considered a non-correlated asset, a digital alternative to gold. Long-term infrastructure bet. These institutions aren't just chasing short-term gains. They're investing in future infrastructure of finance, custody solutions, trading desks, and blockchain research. It's about being positioned early for a digitized economy. In other words, they're not trying to time the market. They're trying to own the rails it runs on. So what this means for the market, let's talk implications. Legitimacy and stability. When firms like BlackRock move in, they bring compliance standards, security, and mainstream visibility. That encourages other institutions to follow, banks, pensions, and even governments. Reduce volatility over time. Increased institutional participation tends to smooth price swings. While crypto will always have volatility, larger capital pools can create a more stable ecosystem over the long run. Policy and regulation. With major firms involved, there's a higher chance of favorable policy development. Why? Because these firms have a voice in Washington. They help shape regulation, and they want frameworks that allow them to operate safely. Retail access gets easier. As these ETFs or financial products become more available, everyday investors can gain exposure through IRAs, 401ks, and traditional brokerages without needing technical knowledge. In short, this shifts Bitcoin from a niche asset to a normalized part of the financial landscape. Where is all headed? What's next? Expect continued development of more spot ETFs globally, crypto-based index funds, integrated digital wallets through brokerage platforms, tokenized securities, blending traditional stocks with blockchain tech. BlackRock and Fidelity will likely lead the charge, while Vanguard may continue a more indirect path, focusing on infrastructure, data services, and Bitcoin-related equities. This isn't about hype cycles anymore. It's about financial infrastructure evolution, and these firms want a front row seat. So in closing, BlackRock, Vanguard, and Fidelity aren't just testing the waters. They're building positions for the long game. Their involvement marks a turning point for Bitcoin and digital assets as a whole. It's not about if anymore. It's about how they shape the next financial era. If you found this breakdown useful, subscribe to the channel and drop a comment below with your thoughts on institutional investing in Bitcoin. More focused insights coming soon. Stay tuned. Start stacking today. Join Coinbase with my link in the description and get free Bitcoin just for signing up. Don't wait.